Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. A big one, as always. We are going to start with some news, including some updates to your portfolio.
Yeah.
We're also maybe going to have a bit of a rant about financial advice. We're going to talk about the Sohn Hearts Minds conference. 11 fund managers pitched their best ideas. We're going to go through them all. And then we're going to close with Charlie Viola joining us for another Pimp My Portfolio.
Love it. Well, let's crack in.
News and markets.
All right, Ren. Well, I wanted to take the top of the show because whenever there's a move in our portfolios, we bring it to the table.
Yes.
We're transparent about it.
Yes.
We share it with the community. And as fast as MinRes became a position in my portfolio, It's now out.
So for context, Mineral Resources is an Australian mining services company. They process iron ore, but then they also have a lithium division and a couple of other divisions. You bought it in September from memory, and you absolutely nailed the timing of it.
Yes.
The MinRes share price had been falling alongside the lithium price and the iron ore price, but mainly driven by the lithium price. In September, you bought, and it almost doubled in about a month. It was up like 75% in a month, and you were on top of the world.
I was.
Then Mineral Resources founder Chris Ellison gets done for tax evasion, and there's some other stuff that's happened, some related party transactions. He gets booted from the company. Well, he's going to leave in 12 to 18 months. And the share price has come down a fair bit.
Yes. Well, you've just stolen my whole segment. So.
Oh, well, no. I mean, I feel like that's the context. Now the question is, why have you sold it?
Why have I sold it? It was a tough decision, to be honest. There are still a lot of good things about the business. You mentioned the mining services division, like it's pretty robust. The way that it's set up, it's got long contracts. It's not impacted so much by the down cycles. But before I bought it, it was being pumped, as you said, by the lithium price because it was so tied to that. So it just felt like a good opportunity to get into it. They called the bottom of the lithium market as well, and so I did jump in. However, we say on this show time and time again, when your thesis changes, it's time to sell your investment.
Or your thesis breaks.
Oh, sorry, your thesis breaks,
Yeah.
yes, when your thesis breaks. And whilst all of that still remains true in terms of the business, one of the biggest parts of the thesis was Ellison himself, Chris Ellison, the founder, known as an incredible deal maker, known as someone who's been able to produce incredible shareholder value for the company. And so for me, whilst he still remains in the company at the moment and is one of the largest shareholders and probably still has quite an influence in decision making, his time is limited. And I question if he can actually last the full 12 to 18 months because more and more keeps coming to light about the corporate behaviour of what's going on at Min Resources. So for me, I have limited capital to play with in my satellite portfolio, and to have this investment sitting there potentially going sideways for 12 months, I figured I'm going to get rid of it and wait until there's a bit of a clearer direction on where this company is going, who's going to be leading it, and what Chris's position is going to be, and use that capital elsewhere.
Nice. Makes sense.
So tricky one though, because I still feel like we'll see.
You still made,
I made about
dollars.
35%.
Oh, okay. So you sold a little while ago then.
Yeah.
I don't believe you that you made 35%.
Yeah, I saw... Let me see. I made 18.79%.
Okay. That's very specific. That's not bad, All right. Well, good to know. I think a lot of people, well, obviously a lot of people are getting out of mineral resources given the selling volume we've seen. So you're certainly not alone. And it'll be interesting to see
Well,
what
it's just
happens
also
there.
interesting, tricky as well, given some of the largest shareholders are still like pressuring the board not to get rid of him.
Oh, 100%. It's the same like with Richard White at WiseTech. Like some of these big investors have built, billions of
Serious
dollars of
wealth.
wealth from writing these founders. You can understand how these investors get in the trap of looking past a lot of bad behavior.
Yeah. So I'm going to keep a close eye on it. It's one that I think, when things start to turn around in its mining division particularly, there could be some pretty quick upside.
All right, Bryce. Well, I said I wanted to have a quick rant about financial advice, and let's keep this quick because there's nothing we can do here, but it's frustrating. So Australia's financial advice industry is a bit of a mess. The number of advisors since the Royal Commission in 2018 has gone from 28,000 to 15,500. So the industry's almost halved. At the same time, the cost of advice has gone up. The amount of money you need to justify seeing an advisor or for an advisor to take you on has also steadily increased. 15 years ago, 20% of Australians had an advisor. Today, it is 10%, and that number is falling. Advice is broken. In 2022, there was a quality of advice review done by Michelle Levy, and she had a whole slew of recommendations to improve accessibility of advice. And what we are seeing play out is just a classic example of vested interests and lobbyists getting in the ear of government and government listening to those over the people that they're actually trying to help. That's my view. That's my personal opinion, but it's shitting me. Because on one hand, we have the Labor Party listening to the superannuation industry and their lobbyists, and the super industry have a massive vested interest in this. And then the coalition now are lining up behind the financial advice industry and their lobbyists. But you know who no one is listening to?
The people that
The
need
90%
advice.
of Australians that need advice.
So the context here is that the government took all 12 recommendations and we're going to try and push it through.
Yeah.
Yeah. And now all of a sudden it's come out. And one of the major pieces was around being able to provide a different type of advisor, which would allow you to get essentially advice through superannuation at a more cheaper cost. And this is where all that lobbying is really starting to kick in.
And the superannuation industry have a problem. And their problem is they are seeing members leave once they get to retirement age or close to retirement age. They go and pay for advice because they need help and they have the assets to do it at that point in their life. And the super funds then lose their clients there. And so they want to stop that. And so they've got this vested interest to be able to offer advice through super, and they want it's like subsidized by the overall cohort of the membership. So like you get advice from your super fund, you don't pay for it. Everyone pays for it. The financial advice industry hate that because then all of a sudden they're competing with a service which is at no upfront cost. I also hate it because I think we've gone through the era of product issuers being the ones that give advice.
Yeah, exactly, yeah.
And that led to a lot of bad outcomes.
Yeah.
That's not what we want. We want independent advice. But the other thing that shits me is like we're really going down this route of to quote the government and the report, it's this quote new class of advisor with fewer qualifications and less expertise. And it's like, is that what we want? Or do we just want to remove some of the red tape and some of the burden on existing advisors so they can offer limited or scaled advice without a $6,500 upfront statement of advice fee? Like if we can get that to $1,000 for an hour or, a 2-hour meeting with an advisor to set people on their right course, I feel like that's what we want.
Yeah,
we don't want product issuers giving it advice, and we don't want less qualified and less people with less expertise giving advice.
Well, I think part of that, Michelle did have part of that as her solution, but it seems like this is where the focus is at the moment.
I guarantee you they're going to butcher this.
Well, who knows if anything will even go through. Anyway, we're going to keep a close eye on it because it is something that's very important to the Equity Mates community, and that is getting affordable financial advice.
Yeah, it's just like support the advisors who are there, try and get more advisors in the industry and try and remove the red tape to bring the cost down so experts can give independent advice to the people that need it at an affordable price.
So, Ren, last week, Adelaide hosted Australia's most well-known and largest stock picking conference.
Yes.
The Sohn Hearts Minds conference, where some of Australia's and the world's best investors get together and pitch their highest conviction stocks for the next 12 months, all in the name of raising money for medical research.
Yeah, so this is the Sohn Hearts and Minds conference. We had 11 stock pickers get up on stage and pitch their best ideas. Every year, there are some great stock picks and some that don't do as well. Last year, the best stock pick was Telix Pharmaceuticals, which was up 150%.
Yep.
That's from Ricky Bannon, who has been on the podcast a couple of times before. About a year ago, she also pitched a stock that was up 600% in that time. So if that's not a reason to keep listening to Equity Mates, I don't know what is. But there's also been some pitches that have not done so well. Last year, Miniso Group, a Chinese company, was down about a third. And there was a pitch to short the Japanese tech company Canon. Canon's up 30% in that time.
Yeah, tough ask for these experts to find something that has a 12-month time horizon, but nonetheless, some of them managed to do it pretty well. What we're going to do today is we're going to draft the 11 stocks. We're going to pick one each to create a portfolio and give you a bit of insight into what was pitched by who.
Yeah, we'll actually pick 5 each. We'll go one at a time, and then that means there'll be one left over, which will be our Mr. Irrelevant. Or you can kick it off. You can take the first pick of the draft.
All right. Look, I'm just going to start with a random one. 10 Cent Music.
Okay.
Yeah, so I'm going to go 10 Cent Music, pitched by Samir Mehta from J.O. Hambro. So the pitch is that, look, they're buying back a bunch of stock to the tune of $1 billion and generating a fair chunk of cash, which he says is not something that you often see from Chinese companies. I think they have about 120 million paid subscribers as well.
Yeah.
So 10 Cent Music is what I'm going to take as my first, Ren.
Nice. Now, I'm going to take TransDime, which is a company that is often spoke about in terms of these like super high quality long-term companies. It was pitched by Jordan Katz, Advent Global Opportunities. It's a plane parts manufacturer listed over in New York. Jordan's pitch was the long-term pitch for TransDime. I'm a little bit skeptical about the 12-month holding period and like what's going to be the catalyst in the 12 months. But to quote Jordan, he said, when an airline buys a plane from Boeing or Airbus, they're simultaneously entering into an uncancelable 40-year subscription with TransDime. Where next time you're sitting on a plane anywhere in the world, flip over the buckle on the seatbelt, you'll see the brand and safe. That's a TransDime subsidiary. The air travel industry is only going to keep growing, and TransDime have this dominant market position. I am a little bit skeptical about the 12-month time horizon, but that's my first pick.
Nice. All right. Well, I'm going to stick with air travel and go Airbus from Vihari Ross for Antipodes. So Airbus, the major competitor to Boeing, specializing in manufacture of commercial airlines. The pitch was essentially, look, Boeing's woes are helping Airbus. They're operating in a pretty strong duopoly, and they're actually the leader in short-haul travel. But longer term, obviously this goes beyond the 12-month horizon, but longer term, as incomes grow, people's desire to travel increases. And Vihari has said that there's going to be 4 billion additional passengers over the next 20 years, and that's going to be driven by emerging markets. So definitely a long-term play here, but I think given the short-term woes of Boeing, perhaps that's why she's gone it.
So my second pick is going to be corporate travel management, pitched by Ricky Bannon of IFM Investors. This really reflects a theme from the event, which is there was a lot of beaten up stocks pitched. Corporate travel management is down about 30% since the start of the year. It provides travel management software for the corporate market. Like if you work for a big company and you've ever had to book corporate travel, likely it's been through their portal, planes, hire cars, hotel rooms, all that stuff. It's a high quality company that's been absolutely battered. Ricky thinks it's an attractive turnaround proposition. More than anything, I'm just backing Ricky in because she pitched the winning stock last year. We've got a lot of travel themes so far.
Wasn't expecting her to go down that route, but a company that's been spoken about a fair bit this year. I'm going to go with a pitch by Alex Polak from Loftus Peak, and that is Eli Lilly. Now, Eli Lilly is a multinational pharmaceutical company, certainly one of the leaders in the GLP-1 drug space, but Alex thinks that there is a little bit of mispricing going on because the market is missing something big, which is Eli Lilly's diabetes cure called Zepbound. It's a drug considered to be a cure-all for a range of diseases. Now, if the market are missing that and ignoring that, then pretty big upside if they've figured out a cure-all for a range of diseases, but Eli Lilly in the portfolio.
All right, I'm going to go a different direction. There's a number of beaten up stocks, but I'm going to pick a stock that's up 155% over the past year. I'm going to back in silver. And I'm going to go Koa Mining. It was pitched by Jeremy Bond of Terra Capital. It's, I think, the 9th biggest silver producer in the world. Jeremy's backing a precious metals bull market, and he thinks Koa Mining is the best way to play the silver story because he thinks it will get benefit from the uptick in price, but he also thinks the company is massively deleveraging and starting to really perform.
Nice. I'm going to go a stock from Benit Kathari from Techne Capital Management. We've had Benit on before, and this is controversial because it's giving more Chinese exposure to the portfolio. But he pitched DD Global, which is a Chinese ride-sharing app, not even a competitor to Uber because I don't think Uber exists in China. But the pitch is essentially he believes that the magnitude and durability of its earnings power are misunderstood and mispriced. So betting that the market has got it wrong. He says that industry-leading profit growth at 3 times its global peers average is pretty compelling.
Yeah, so DD got delisted from the New York Stock Exchange and is now trading over the counter. So Benit actually needed an authorization to pitch it.
Oh, really?
Under the theory that it will probably be listed in Hong Kong at some point again. So, but you know what? Like, despite all that, it's up 24% in the past 12 months. So credit where credit's due. Like, it's still doing the damn thing. All right. We said this year was all about the turnaround stories. Yeah. I'm going to pick a company that has had a shocking 12 months. Estee Lauder, down 80% from its recent highs. This was pitched by Fleur Wright of North Cape Capital. Estee Lauder, people probably know, it's a cosmetics giant, manufacturer and marketer of makeup, skincare, perfume, hair care products. We all know the brand. It's fallen 80%, largely because of the China luxury story. Like, a lot of the luxury goods players have sold off because the Chinese economy is weak. And the marginal buyer is really in China. And they're not alone. Burberry's down 80%. LVMH is down 35%. Like, a lot of luxury has sold off. But Fleur is making the pitch that it's a quality company. The worst is over. And she's buying it again. And that's the one I'm drafting.
Nice. I'm going to stick with the turnaround story, a stock that's been absolutely beaten up from its highs. It's listed here in Australia. It's Perpetual. Okay. Now, Chris Cortis from Elliston Capital, he pitched this stock. It's a listed Australian financial services provider, investment manager, and over the past year or so, it's gone through it's in the midst of going through a demerger, having agreed to sell its valued corporate trust and wealth units to private equity firm KKR. Now, it hasn't quite been completed, but if it does, shareholders are going to receive about $1 billion. And Chris believes that it's trading at a massive discount compared to its peers. In fact, he said it's the cheapest listed asset manager of scale in the universe. So this feels like a deep value play, one where if they can sort out their structure and sell off the assets, then there's some upside there.
Okay, that leaves 2 companies, and I don't know enough about either of them, which is probably why I haven't picked either of them. I'm going to stick with the US tech because that's the sexy one here. I'm going to draft as my final pick Blackline. It was pitched by Sumit Gautam of Scalar Gauge, who we had on the podcast recently. You can listen to that. It is a cloud software platform that automates financial operations, and Gautam thinks their earnings are about to explode. His words, not mine. So that is just a B2B SaaS company. It's worth less than $4 billion now. And so, if its earnings do explode, hopefully its share price does as well. That is the draft. The one that we didn't pick, so this is our Mr. Irrelevant for this draft, pitched by Ricky Sandler of Eminence Capital, Cellnex, which is a Spanish telecommunications infrastructure operator with 100,000 odd cell tower assets. So neither of us picked,
Don't know too much about Spanish telecom.
Neither of us picked the infrastructure play.
No.
But look, they're the 11 stock pitches. Head over to our Instagram and we'll put the two portfolios we just drafted head to head, and you can tell us which one you think was better and which one you think was worse. But yeah, Bryce, that does it for Hearts and Minds.
Nice. Well, we're going to take a quick break, and on the other side, we will be right back with Pimp My Portfolio. A reminder as well that one of our experts, Adam Dawes, is providing a professional portfolio health check if you would like. So for $750, you can get Adam and his team to have a look at your portfolio and align it with your goals and provide you with a statement of advice to give you some professional advice on how you can set up your portfolio. So head to equitymates.com/advice. If you'd also like to join us on Pimp My Portfolio, head to the same link. We'll be right back. Welcome back to Equity Mates. It is time for
Pimp My Portfolio. Pimp My Portfolio.
That's right. If you've just joined us, this segment is where we bring in an expert to review the portfolio of a community member. And our expert joining us today is one of Australia's top-rated advisors, Charlie Viola. Charlie, welcome.
G'day, gents. How are we?
Very well, very well. And on the phone, we have Kyle. Kyle, welcome to Equity Mates.
Thank you very much, Bryce.
So, Ren, as always, what have we got in Kyle's portfolio?
Yeah, so Kyle's portfolio is anchored by 3 ETFs. The biggest position is the BetaShares NASDAQ 100, which is about a third of the portfolio. Then he also has iShares S&P 500 and EFI, the BetaShares Global Sustainability Leaders. Together, those 3 ETFs are 40% of the holdings. Then the other 60% is split between 6 Aussie stocks: Bank of Queensland, Bendigo and Adelaide Bank, Westpac, ANZ Group, Coles, and AGL Energy. So, Charlie, we put you on the spot. Coming up with a nickname. So, what do you have here?
Oh, I reckon we call this one "Take It to the Bank."
Okay,
Take it to the bank. Nice.
Because Kyle's done a pretty good job, but I'd love to know his fascination with the Aussie banks, because 53% of his portfolio is made up of the banks, including some regional ones, which is which is probably atypical of what most people's portfolios look like.
Yeah. Well, Kyle, over to you. How do you respond to the name, and maybe perhaps if you can shine a bit of colour, shed a bit of light onto how your portfolio came to be?
Yeah, no, that's a pretty fair name. I guess I started investing. I'm 24 now. I started looking when I was 19, just how I could do. I got my first $5,000 and was like, oh, what can I do with this? And had my dad say, oh, you could put it in the stock market. Did a bit of research, and that's where this all started, I guess. And I just wanted to save things that would just return money. So obviously the banks are pretty good-looking stocks, as everyone loves to see. And I just went down that path, and then I hit the time of COVID. And, yeah, that's when all hell broke loose. And I got onto Equity Mates. That's when I started listening. And you guys are one of the reasons I didn't sell. And I just kept buying and dollar cost averaging, and the banks just looked really good and really good value for money, because I'm like, well, everyone uses a bank, and I just kept doubling down on that. And only, I guess, in the last 2-3 years, I've really looked at switching to the ETFs, and even now looking at probably getting out at some of the banks and going to more ETFs, so I can just sustain the income, but also get that growth that the banks are probably now kind of capping out on for me.
Carl, I think we got to start with, being 24, having an investment portfolio, like, you're doing a lot right. So I think really well done for getting started and sticking with it in that tumultuous time of COVID. But Charlie, over to you. I reckon a lot of clients that you see probably have a lot of exposure to the banks. And I guess, so maybe let's start with the banks, how you'd approach that, and then let's talk about the portfolio more generally.
Yeah, they do, right? Every client will have reasonably big positions in the banks, and really most investors have big positions in the banks. They've almost done nothing but go up for 15 years, right? And we're all in love with the dividends and, with imputation credits and what have you. So it's not atypical to see people with big positions in the banks. It's probably less typical to see them with big positions in the regional banks like Bendigo and Adelaide Bank and Bank of Queensland. So, and look, these things have probably performed sort of reasonably well over the last couple of years. So, Kyle, you've done a reasonably good job. And even really with your split between sort of domestic to international, where you sort of a 60-40 split, it's not kind of the worst thing in the world. In terms of what I'd probably do from here, I would say that these banks, especially these regional banks, which are the first ones that are going to feel the pressure, are probably looking 10 to 15% overvalued. I'd probably suggest that, even the majors probably look 10 to 15% overvalued. So I might be taking a little bit of winnings from there if I was you, or we were sort of critically looking at this portfolio. And I'd probably start to increase your exposure to some of the more broad-based ETFs, which you've already said that you're going to do, right? So IVV, NDQ, and even maybe VAS you could add, or, not to add more banks to your portfolio, maybe a stock like MVW, which is the VNAC equal weighted, which equally weights the top sort of 80 or 90 stocks in the market. So, and then really the only other thing is I'd probably get rid of this ETF, ETHI, the NetShares Global Sustainable, unless you've got some really kind of strong feeling like you need to be socially responsible in some way. It's just kind of taking money away from kind of the broader exposures that you should sort of have and should be adding to. So, I don't know. You've done an okay job, and I think you've sort of ridden the winners. But I think it's probably maybe time to take a bit of value and just reinvest in the broad-based stuff and try and keep it simple.
So, Kyle, what are your thoughts? Did you have any follow-up questions?
No, honestly, that was like my thoughts, and it's nice hearing an expert tell me that. That I'm almost like, I guess, flogging a dead horse in terms of the profits are probably getting to the max they can. And, I was looking at cashing out some of them, especially that ETHI. The only reason I'm holding it is 12 months for the capital gains tax, so it just comes down. And then I'll sell it. And, even the Coles ones, like, they're not doing much for me personally. I look at something like JPEG that I've been listening to you guys the last couple of weeks, and that's something that struck my interest. I do like the NASDAQ. It's just techie. It's got nice growth, and with that JPEG went off, I don't mind my dividends, so it does return, and I love reinvesting dividends and just growing the portfolio as much as I can. So
your point, though, about remaining diverse, ensuring you've got good coverage across the various different markets, and maybe removing a couple of your kind of single sector or single stock exposures when the portfolio was only this big, makes absolute sense, right? And certainly if somebody came to us with small amounts of money that they're adding to every month, we would hardly ever go and buy, take individual kind of stock risk the way that you've done it. And like I said, you've kind of picked a really good period where credit growth's been really strong, and money's obviously flowed into the banks, and people have kind of viewed them as these really good quality kind of bond proxies, but they do, just on a pure fundamentals basis, probably look a little overvalued from our perspective. So nobody ever went broke taking profits, right? So take some profit, diversify your money, reduce your risk, and then just keep adding to those kind of good quality names, or those good quality kind of ETFs over time.
So, Charlie, just more generally on the income thing, it's certainly something we hear from our community a lot. It feels like dividends and income are really in vogue at the moment. But a lot of people that are in our community are on the younger end of the scale. Bryce and I like to think we are still on the younger end of the scale. How would you approach the balance between focusing on income now versus, like other assets that might have more capital growth for people who are younger?
Yeah, I like to think I'm on the younger end of the scale too. But anyway, I love how you just looked at him and said that rather than...
All right. Well, for all of us on this call who are young and got years ahead, how do you balance those two?
Yeah, look, I think the answer is unless you need the revenue, unless you need the income, we're just looking for the best total return, right? So, the banks have probably been that really good example that if you actually look at the kind of accumulation value of the banks over a period of time, the return's been really good because they pay, 75% of the profits out. If you're simply reinvesting that, you end up kind of with that same sort of growth impact anyway. It's just a little less tax effective because you're obviously paying the tax along the way. So look, we're big ones for looking at these things on an absolute basis. Look for where there is value, look for where there is earnings growth. If those earnings are being paid out, that's fine as long as those earnings are growing, right? We absolutely want to know that the forward earnings numbers look really positive and they've got good market share, good key competitive advantages. If the company has a policy because its shareholder base likes dividends being paid out, then fine. As long as the total return that you're generating is good. I don't know that you have to sit there and kind of go, I'm going to pick this one over this one because it's paying a better yield. Let's just look for the best underlying investment. If that makes sense.
I think you'd also find you'd get a fair bit of overlap, Kyle, with JPEG and BetaShares NASDAQ because it's pretty tech focused as well. So something to consider there.
Just something along the lines, I guess.
Given the size of that mega cap market, there's absolutely nothing wrong with having a reasonable portion of your portfolio sort of committed to that. But again, I would keep it diverse, right? Like I would, and I would just keep adding to it and kind of, hopefully just live what's hopefully a nice sort of smooth ride if you're investing across a good diverse range of assets.
Now, Kyle, I've got a question for you because you said you were 24 earlier, and when I was 24, I was punting on small caps and speckies and thinking about how I could get rich quick in the market. But you've built an individual stock portfolio of 4 big banks, a big supermarket, and a big energy company. So did you just skip the stage where you punt on speckies and make stupid decisions, or are you just smarter than I am?
Nah, look, when I first started, I definitely thought about that. I was like, surely I can just pick one of these, right? And it goes up 100% and I get rich quick overnight, right? That's what we all want.
Yeah, that's the dream.
Yeah, 100%. But I have a very good set of parents who've done quite well and definitely guided me. So I'm very fortunate for their advice. And, the one thing my father always told me, you never get rich quick overnight. So after I tried it once, like I did, I put $500 into some stupid, probably, I can't remember what it was, like when I was 19. And I was lucky enough, it did double. And I pulled out and go, I'm never doing that again because the panic at $500 when I was 19 was... my heart was racing up and down like I was riding a horse on the straight down Flemington. You know what I mean?
Nice. Well, I think that's a good lesson for everyone that, you don't have to punt on crazy stocks, that you can build a portfolio of sensible long-term companies.
And parents telling you advice at 19 is one thing, but listening to it is another. So well done, Kyle.
You're that rare person who's learnt their lesson from having a really good outcome as opposed to having a really bad outcome. But,
I know, right?
The rest of us learnt that the actual hard way, where we put $500 in and it turned to dust.
Exactly. And that was always the risk, right? Like I put in there and going, I'm willing to lose it, and then you go, am I really willing to lose that?
That's good. That's good. Well, thank you so much for submitting, Kyle. We appreciate all the community members who step up and share their portfolios so that we can all learn from you and the conversation with the experts. So thank you so much, and Charlie, as always, thank you for sharing your time with us and with Kyle.
No worries.
Yeah, thank you very much, guys. Appreciate it. Thanks for having me on the show. Big fan.
Well, we appreciate you guys tuning in each week and supporting the show. So good luck with it.
Yeah,
and,
good luck with it.
Thank you very much, guys.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the information is there.
All right, Bryce. Well, that does it for this episode of Equity Mates. Just a reminder for people, if they want more of us, if they're not getting enough of us here over on Equity Mates, we have another podcast, Get Started Investing, which is really all the basics you need to know to get started investing. If you're an experienced investor, it's always worth reminding yourself of the basics as well. But we do cover different content. And next week, we are reviewing the hottest new ETFs of 2024. There have been a bunch that have dropped on the Australian market this year. We're going to go through the most popular, those that have got the most inflows, and those that have performed the best. So make sure you subscribe to Get Started Investing wherever you're listening to this so you don't miss that episode.
But Ren, that brings us to the end of today's show. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.